What's your expectation in terms of cuts, Carl, now? And here's a question for you. So we talked about how mortgage rate may not come down that much. That's in part because the 10-year, the long end, rallied a little bit since this rate cut. Is that because of fiscal dynamics? Is that better growth hopes? Is it the potential for a little bit more inflation down the road? Because that's going to be the more direct impact to mortgage and to housing.
Yeah, a bit to unpack there. First, I do think it's premature to conclude victory over inflation. Let's not forget in the second half of last year, we got those clicks at 1 or 2/10, and we thought job was done. And then we had a first half that was disappointing. There's still the potential that could happen, especially if the economy continues at a 3% real pace. Secondly, for a long time, the mortgage rate was at a much higher level relative to the 10-year than it had been before for technical reasons. It's coming down. We're beginning to see a little bit more activity in the housing sector. That, too, could add some momentum to an economic picture that hadn't had it until now. And so, again, I certainly respect the 50 basis point move. The outlook still seems to be solid. The thing I think that won the day, and Steve, you can chime in on this, in the back, the balance of risks. The group is getting a lot more confident about inflation and a lot more anxious about the employment picture, and that's probably what won the day.
Based on the data you have, we're all looking at the same official series, but maybe you have alternative data. There's lots of private sector measures now and that sort of thing. Do you think we're headed towards having a negative payrolls print in the coming months?
I certainly wouldn't have one in the forecast.
No.
We are still seeing decent labor demand conditions. Those who leave jobs find new work very, very quickly. If people are losing jobs, they're not claiming unemployment insurance benefits because that series has been very well behaved. And certainly some of the alternative measures of job openings, because the JOLT survey is one of the ones that we have the most questions about, are still showing pretty solid labor demand.
So why would that argue for a Fed concerned about the labor market going 50 instead of going, hey, this looks pretty good, let's start with 25?
Yeah, I think the trickle and flood argument is the one that I've heard most often. You can occasionally get small movements negatively in the labor market, and then all of a sudden hiring managers conclude that it's a really good time to get thin, and then you can see an acceleration up from here. For the longest time, talent has been scarce. People have wanted to hold on to what they have. One never knows when that dam will break.
I see. So there's basically, and Steve, curious your take on this sense that, we're slowing, and all of a sudden we're breaking down.
Yeah, I mean, I would think of it, Kelly, more in terms of risk management. That's where I think the Fed decided on the 50. They said, hey, what is our biggest risk right now? And the revelation of those PCE numbers or forecasts from Waller is kind of a game changer, that they're looking not just at a below target inflation number for August, but when they start measuring in the index finally catching up with the decline in housing inflation and beginning to incorporate that, you potentially get to a number that is 1% or lower or well below target. So that becomes a risk. And then you start factoring in, well, what is my bigger risk? What's happened to the job market? And I think we have to remember, on this show, Kelly, I did a report about the paper from Jackson Hole about the beverage curve and the relationship between job openings and unemployment, and that we're reaching that level of one open job for one unemployed person. That is a threshold where the authors of that research paper, which a lot of Fed officials liked, thought, you know what, it's a place to start to get worried, where the next moves are those that increase unemployment, not just get rid of job openings.
I think that's absolutely fair and probably key here. And Carl, just to continue my devil's advocate argument, is it a problem if inflation's below target, if the labor market is not weakening enough? In other words, why do we care if inflation wants to run at 1.8% annualized and we're coming after 20% increases during the pandemic? Wouldn't we welcome that as long as the labor market's still strong? They normally go hand in hand, but what if it's different this time?
That's a great question. We're starting to get some relief on service prices, and the chairman mentioned that in his press conference. So further weakening in the labor market is probably not as essential to achieving the inflation target as it was earlier in the year. The last thing I would say is Jay Powell has 18 months to go in his term, and I think he'd like to leave the economy firmly in soft landing territory. He's very proud of what the Fed was able to do with bringing unemployment down and broadening opportunities for all Americans. I think that would be a legacy he'd like to preserve.